LiteFinance, the world of financial freedom.
Hello everyone, it's Monday, August the 30th. We are starting a market forecast. This time I will focus a little bit more on macroeconomics issues because we have quite a rich calendar for this week, and I think that maybe it is worth talking a little more about the very foundations and the situation in the world today. So this week on the calendar we have manufacturing and services PMIs offering the first comprehensive look at economic conditions. The tight economic calendar will also give us information from the US labor market, which are naturally NFPs. Data on inflation in Eurozone and several countries, including Australia and Canada, will also publish their GDP for the second quarter. As for payrolls, the Fed has indicated that asset purchase reduction may begin before the end of the year, so payrolls might give us a hint of how aggressive these cuts might be. So if the reading is higher than expected, a faster and larger cut may be expected, while a much weaker reading may raise concerns about economic growth in the US. So following this lead, a good reading should theoretically mean a strong dollar, and a worse reading would mean a weaker dollar. But of course, this is just a theory. As for inflation in the Eurozone, forecasts predict an increase to 2.5%, which is in line with the earlier PMI data for July, which showed us that the prices are rising at the fastest pace in 20 years, so this time the consensus might be right. So preliminary PMI reports showed us that the Eurozone overtook the UK and US in August, both of which saw a slowdown in growth along with supply chains problems. Australia and Japan also saw a decline in activity in August, largely due to the spread of the Delta variant. Overall economic activity in the private sector in Australia declined for the second month in a row in August, according to PMI data, and it is worth noting that the pace of the slowdown accelerated in July. Subsequent lockdowns contributed to the decline in demand and production, and consequently the labor market deteriorated. At that time, inflation was historically high and material costs rose also in August. So all this probably contributes to the GDP reading worse than previous one, which is in line with the forecast. In addition, we have an OPEC Plus meeting on Wednesday, which is one unknown due to the last silence we have regarding public statements of the representative of the member states. However, at the moment, with the significant problems with the new variant in the production and material supply zone, they may not be tempted to another race. In turn, the United States want cheaper oil to support their local economic growth. In addition, the Russians plans to gradually increase production, so in May next year they would reach the pre-pandemic level. And finally, to stir things up even more, I will add information from the latest forecast of the US Energy Information Administration, which shows that in the first quarter of 2022, production will start to exceed demand. Taking into account all the above-mentioned factors, I would rather expect no reaction at the moment, and the oil price oscillates around $70 on WTI for a barrel. For example, of course, right? We have also the Brent. If in turn we receive clear information about further increases in production, it may happen that oil will drop significantly after such news. So okay, that's all from me for today. Thank you for watching, and yeah, see you soon, guys.